We're so used to thinking in terms of active or passive, almost as if they're mutually exclusive, almost contradictory investment approaches. But the reality is that if you think about passive products, just like active investment funds, they're simply tools for asset allocators to use when it comes to building portfolios of various kinds.
Hello everyone and welcome to a new episode of The Blunt Dollar. Today's guest is Sefian Kasem, and if you think ETFs are boring, you haven't heard him talk about them yet. Sefian leads the global ETF and indexing investment specialist team at HSBC Asset Management, managing over 100 billion across some of the most dynamic passive strategies in Europe.
A lot of investors are concerned about concentration risk, especially when they look at the US market cap indices. If you take any ETF and use that as a tool for gaining access to US equities, you as an investor would decide when to get into that position and where to exit. And all of those are active investment decisions.
This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Hello everyone and welcome to a new episode of The Blunt Dollar. Today's guest is Sefian Kasem, and if you think ETFs are boring, you haven't heard him talk about them yet. Sefian leads the global ETF and indexing investment specialist team at HSBC Asset Management, managing over 100 billion across some of the most dynamic passive strategies in Europe. With a PhD in mathematical finance from Imperial College and a career that spans cross-asset trading, credit markets, and asset allocation research, Sefian has one foot in the macro trenches and the other in product innovation. In this episode, we get into the real engine room of the ETF revolution. We also explore how ESG and Sharia-compliant frameworks are converging, why the active versus passive debate misses the point, and what real diversification means in a world of inflation, political risk, and rate uncertainty. So if you're managing portfolios, allocating capital, or just trying to future-proof your investment strategy, this conversation is one that you won't want to miss. Sefian, it's an absolute pleasure to have you on the show. Welcome to The Blunt Dollar.
Thank you very much indeed. It's an absolute pleasure to be here.
So tell us a little bit about what is it that you're doing at HSBC?
Sure thing. So currently, I'm the global head of the ETF and indexing investment specialist team within the passive business. So we look after all of the ETF and index funds within HSBC Asset Management. But I also double hat. I also work as a lead investment specialist for the portfolio advisory and outsourced CIO business within the asset manager as well.
Very cool. So we're going to get into more details, of course, about your current position. But before that, I want to take a step back and go to the beginning, because you didn't start at HSBC, obviously, out of the blue. You went to the university, and as a matter of fact, you have a PhD in mathematical finance from Imperial College. And I was curious about that. What drew you into the world of mathematical finance?
Very good starter for 10 questions. So if I think back to kind of the late 90s, early 2000s, when I was hitting university, mathematical finance was a super popular subject area. So it was really mushrooming in terms of interest amongst a whole range of different students. So I personally was studying economics and finance at the undergraduate and master's level. But I noticed when I got to the master's level that there were a lot of engineers, physicists, and high-level mathematicians that were moving into finance, quantitative finance in particular, as it was known back then. So I thought I'd have a look, see what it was about, and just got sucked in, really. I found it fascinating, super rigorous subject area. There was a lot going on, big buzz around it at the time. So I decided to do a PhD in the area, which I did. And I then finished that or completed that and began working actually at HSBC around the time of the global financial crisis. So kind of early 2007 is when I joined the firm. And it was a fascinating time. It was fascinating to live through that. I was fortunate enough to be a trader over that period. And when I think back and I contrast the market calm, if you like, of kind of 2004, 5, 6, and early 2007 to the absolute mayhem, that's the only the way I can put it, really, of 2008. It's incredible, really. It was a real baptism of fire. So I spent some time after that working as part of the credit trading business within global markets. I did that for a few years. Then moved over to HSBC Global Research, where I worked as an asset allocation and a multi-asset strategist for a few years. And more recently, back in 2020, I joined HSBC Asset Management at a time when the passive business was really going through a growth spurt. I think that's the right way to put it. And it's been a fascinating and rewarding experience. I'm working with a great team, highly ambitious, lots of energy. We've had a great few years.
Yeah, wow. So tell me about that first year. I mean, you start working and boom, you have the great financial crisis. How did you live through that? What are some of the things that you remember from those days? Do you have some anecdotes for our listeners maybe that were not working at the time, just to get a feel of the mayhem that you were alluding to?
Yeah, absolutely. I mean, honestly, it truly was a genuinely fascinating period. I was lucky enough to work with some really great risk takers, actually, at the time. So I had some great mentors. But I just remember, days when I came in and markets were limit down, and you'd see enormous swings in S&P futures and just big adjustments in currency markets and fixed income markets. And one thing which really struck me was just how hypersensitive markets become to news flow of any kind during a crisis period. So seeing asset prices react so dramatically whenever there was an announcement of some kind, some type of policy announcement, or if a rumor hit the markets or whatever it may be. I remember being struck by the sensitivity of markets to any headlines, and just how they went from being sort of independent animals, different asset classes having their own dynamics, to us really being thrown into this kind of risk on, risk off phase where either risky assets were up on the day or they were down on the day, or they were all moving together one way or the other. So, as I say, genuinely fascinating.
Wow. I wasn't around at the time. Well, I was around, but I was just not working. I was still in uni. But I always have the feeling that after going through that, all the other volatility episodes that came afterwards must have been like a walk in the park. I mean, that seems to me like it was the mother of all crises.
Absolutely.
We haven't seen anything quite like that in the past few years, despite a few market shocks as COVID and so on. But wow, yeah, I cannot even imagine how it was to be working in the industry back then. Now, fast forward a little bit, and now you're obviously very involved in the world of ETFs, a topic obviously close to your heart. So I want to spend a little bit of time talking about that. To me, ETFs are like one of the big success stories of the last couple of decades and the rise of passive investing. What do you think explains this continued growth and boom that we've seen in ETFs over the last couple of decades?
Well, I think a number of different factors. I think primarily ETFs are very versatile investment instruments. So I think the fact that you can use them to put risk on or take risk off within the context of an asset allocation construct, or if you're looking to just gain investment access to a specific market, the versatility of them makes them highly appealing to investors. And over the past few years, we've just seen them explode in terms of popularity. And there's a very rich range of different ETFs across jurisdictions. Whether you look at the US, look at Europe, look at Asia, you can see a rich range of exposures which you can use ETFs to gain access to different markets through. So the fact that that they're very versatile investment instruments, the fact that you now have a number of different asset markets covered, so you have a range of different exposures at your fingertips that you can use for building portfolios and managing risk, I think has been a part of the ETF success story over the past few years.
And talking about that versatility, you've emphasized in the past that ETFs allow investors to very quickly dial risk up or down. And I wanted to ask you, what kind of tactical moves are you seeing more frequently within the world of ETFs for investors, and how has that changed the ETF design itself?
It's a very good question. I think ETFs are definitely being used for making tactical adjustments. If you take a typical asset allocation construct, which has any type of tactical overlay, very often ETFs will be used as tools for making tactical adjustments. That could be across asset classes, if you want to dial up or dial down equity versus fixed income versus commodity exposure, for example. Within asset classes, you have, as I say, a rich range of ETFs in the equity space, which cover not just countries and regions, but also sector, factor, thematic, and other types of ETFs, which enable investors to really build quite rich portfolios overall. So I think you have a very broad, rich range of exposures now, as I say, across and within asset classes, which can be used for making tactical adjustments to portfolios, but also when it comes to building more sort of longer term strategic asset allocation type constructs, so portfolios which have an investment horizon which may be a number of years or even decades, you're also seeing investors look to use ETFs, again, because of their versatility, because of the transparency associated with them, the ease with which you can see the underlying holdings, the transparency with respect to costs, etc. I think all of these factors which make ETFs, which manufactured by different asset managers, very easy to compare amongst each other, have appeal amongst the whole range of different asset owner types when it comes to building portfolios, and even individual investors at the retail level that simply have some surplus capital that they want to invest, and they want to invest it in a specific asset market. ETFs seem to have very wide appeal amongst them too when it comes to deploying capital.
So when I think about ETFs, obviously I think about tracking indices and benchmarks, and everyone knows it's one of the big topics at the moment that traditional benchmarks as the S&P 500 and indices are becoming more concentrated. We're talking about, for example, how top heavy the S&P 500 is, with names like NVIDIA, I think now representing 8-9% of the index on its own. How do you deal with this when you design ETFs, and what are some of the most promising approaches you're seeing to mitigate index concentration risk? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Yeah, it's a hot topic at the moment. I mean, unsurprisingly, a lot of investors are concerned about concentration risk, especially when they look at US market cap indices, the classic benchmarks that you mentioned. They're starting to become less comfortable with the idea that just a small handful of stocks are dominating, if you like, the price action day to day within these indices. I guess I should first point out that it's not uncommon to have benchmarks of various kinds which can be concentrated, meaning that a few stocks are outsized compared to others, and they tend to dominate directionally movements within indices. I mean, of course, you have, for example, UCITS protections, which are in place to protect investors from portfolios which are too concentrated. But the reality is that some benchmarks which UCITS funds track do have very concentrated exposures in certain names. And there are methods for dealing with that, such as capping and rules around capping, which can limit the size of a specific exposure within an index construct. But for investors that feel that an index or an asset class level exposure is too concentrated in a few names, you can almost always, within the ETF space, find alternatives. If you think the S&P 500, for example, is too concentrated an exposure because of its overall exposure to the Mag 7, there are other more sort of broad-based benchmarks, if you like, which have lesser exposure to the US, lesser exposure to technology stocks, etc. So I think it's a challenge. Investors are kind of dealing with that in different ways. That if they're uncomfortable with concentration risk, they may be looking at other benchmarks, so rotating from a fund which tracks a benchmark which has that concentration to one which doesn't. A good example of that is moving from S&P 500 market cap benchmark to S&P 500 equal weight benchmark in terms of the exposure that you have, the US equity exposure that you have. And other investors are dealing with it in different ways. So within the context of an asset allocation construct, in the equity sleeve of that, the US equity exposure they have, they may be diversifying that. An equal weight exposure is a good way of doing that. Others are using factor exposures, sector level exposures, or looking, as I say, at more sort of broad-based, diversified benchmarks. So there are ways of mitigating that concentration risk, either within the context of index design or within the context of portfolio construction.
Yeah, and we're definitely seeing more and more headlines around equally weighted portfolios, and I would expect those to keep popping up in the screens. Given the, as you were saying, the tremendous rally of the Mag 7 and the risk that represents for index investors. Now, we cannot talk about ETFs without touching upon the topic of active versus passive. I know you've been arguing in the past that that debate is missing the point entirely. Why do you think that? Why do you think it's time to retire this framing of active versus passive?
Yeah, it's an ongoing debate. And of course, there are different schools of thought out there. But I think the whole discussion, in my opinion at least, needs to be reframed. I mean, we're so used to thinking in terms of active or passive, almost as if they're mutually exclusive, almost contradictory, if you like, investment approaches. But the reality is that if you think about passive products from either an investment or even a portfolio construction standpoint, passive products, just like active investment funds, they're simply tools for asset allocators to use when it comes to building portfolios of various kinds. They give access to specific markets in different ways. And what I mean by that, to give a concrete example, is if you think about the US equity space, as we've been talking about that, you may, as an investor, think, okay, the US equity space, It's becoming more volatile, a little more idiosyncratic, more fragmented. Maybe it's a good time for active stock pickers to really outperform. So I'd rather have my US equity market exposure within my portfolio or my asset allocation construct in the form of an active exposure, because I believe an active stock picker will be able to generate meaningful returns consistently above and beyond that of a benchmark. Or you may feel that it's a particularly difficult environment for active stock pickers to perform. They don't have any edge. There's too much noise, etc. So you'd rather simply take the return of the market, in which case you're likely to go for a passive product. So they're simply tools which give investors the ability to access specific markets, but also to express a view on whether they feel a market lends itself well to alpha generation through an active investment approach, or whether they simply want to have exposure to the market because they think the market in aggregate or the asset class will do very well, but they don't believe that it's necessarily an environment which is conducive to alpha generation from an active investment standpoint. And indeed, if you think about, how if you take any ETF, for example, if you were to invest in an S&P 500 ETF and use that as a tool for gaining access to US equities, you as an investor would decide when to get into that position, how to risk manage that position over the life cycle of your investment, where you upsize, where you downsize, etc., and where to exit. And all of those are active investment decisions. You're simply using this passive tool, which gives you the return of the market and doesn't seek to give you more than that, as an access vehicle to get access to US equities in the form of an S&P 500 exposure.
I also have the feeling that the lines between active and passive are getting a little bit more blurry, and now we are seeing the rise of these active ETFs, which to me sounded a little bit counterintuitive at the beginning, because to me, ETFs are passive and active fund managers are something else. Like, what is your stance on active ETFs, and where do you see this trend going?
It's a good question. I'm actually quite constructive overall, because I totally understand what you mean. On the face of it, it does kind of seem contradictory that on the one hand, you're talking about an active investment strategy being wrapped in a wrapper like an ETF wrapper, for example, which is typically thought of as being, a passive investment vehicle. Mm-hmm. But the reality is that, you have different shades of grey, so to speak. So active investment processes range from, simple, low active share, low tracking error approaches, where you're simply taking, for example, a benchmark index of some kind, and you have a stock selection or stock tilting investment strategy where you upweight or downweight stocks on the basis that you believe that you can generate a little bit of additional alpha above that of the index return itself. So you have that type of low tracking error, low active share approach. But then at the other end of the spectrum, you have the traditional high active share funds, where you have very concentrated portfolios, and the investors that are, the asset managers that are managing those funds have very high conviction in the underlying names within their portfolio. So I think when it comes to active ETFs, it's the former type which lend themselves well to an ETF type wrapper, where you have some type of investment strategy. It could be systematic, i.e. quantitative in nature, or it may be discretionary in nature even, or some combination of the two. But what you're looking to do is simply generate a little bit of alpha in a risk-controlled fashion, bit by bit over time. So for all intents and purposes, you're delivering the return of the market plus some excess return, hopefully consistently over time. So I think those are a natural variant to traditional passive products, where an investor, again, wants that market exposure, but they want a little bit more than that, because they believe that the asset class level exposure that they want to have within their portfolio, that asset class is conducive to a bit of alpha generation through a systematic stock selection process, for example.
And I'm curious to hear your take from an asset allocator's perspective. You've said also in the past that ETFs are no longer just wrappers, but that they're portfolio building blocks. And I really like this idea of building blocks. I like to think about almost like building portfolios with Legos, where each piece represents, a part of your strategy. How has the rise of ETFs changed the way CIOs, asset allocators, and advisors in general think about structuring portfolios using these little Lego pieces?
Yeah, I think the reality is it's given them a lot more dynamism in terms of their ability to build portfolios with more precise, if you like, risk return profiles. Because, I mean, you described it very nicely. I think of things in exactly the same way, that ETFs are exactly that. They are building blocks, little Lego blocks that you can use to build portfolios, often multi-asset portfolios or others, which have certain risk return profiles. And everything we've said already about the rich range of different ETF exposures which exist within the marketplace, across asset classes, within asset classes, means that there is a very broad range of Lego blocks which can be used to build a vastly different number, if you like, of portfolios with different risk return characteristics. So I think the fact that you have this rich range of tools means that asset allocators, investors have more choice. They can build portfolios in a more precise fashion, so they can help investors meet their investment objectives in a more precise fashion over time, which I think is hugely beneficial. So I think really the ETF wrapper has helped the whole concept of portfolio construction move into a new era in that respect.
There's another topic I want to touch upon related to ETFs, but more like the geographical nature of ETFs. I don't know if it's my feeling or if there's some truth behind it, but I have the feeling that US ETF market is kind of years ahead in terms of scale and infrastructure and adoption. And I mean, I think, I don't have the numbers, but that the biggest ETFs in the world are the trackers of the S&P from the American giants and so on. And I wanted to ask you, what are the structural reasons why Europe has lagged behind the US in all these ETF development? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
I mean, it's a super interesting question. And I think the way I think about things is that there's no doubt in my mind, at least, that much of the innovation within the ETF space came from the US, and Europe is very much playing catch up in that respect. I think a lot of the trends in the US are actually being mirrored in Europe. The most recent example of that is active ETFs. We've seen an explosion of interest in active ETFs in Europe over the past year to 18 months or so. But I think the reality is that the US has very much been a leader in terms of financial innovation for quite a while. So I think they have that edge. But also Europe, I think, and European investors tend to be a little more risk averse when it comes to embracing new types of financial products, new types of investment strategies, etc. But I think Europe's catching up. As I say, a lot of the trends which took hold in the US have also taken hold in Europe. Another good example of that is thematic investing. It's become popular in the US. It's become increasingly popular within Europe, but also by the same token, Europe has its own peculiarities, and I mean a good example of a very European trend is the focus on sustainable investing. That's still extremely important for investors of all types within Europe, irrespective of the broader narrative globally. We still find it's very high up on the agenda for most of the asset owners and other investors in Europe that we speak to. So there are some differences, but I think really and truly it comes down to just the dynamism and the innovation within the financial sphere, which has taken place in the US over the past few years. They've really been a leader in that respect.
So would it be fair to say that we started later in Europe, but that now we're catching up thanks to innovation in different themes like ESG, as you were saying, like hybrid structures, like capital protection and things like that?
Absolutely. So I think Europe is still, even if it's lagged the US marginally in terms of adopting sort of new financial technology, let's word it that way, it's still a very mature, sophisticated investment market in many respects. So I think a lot of the financial innovations, if you like, that you've spoken to just there, so whether it's investment products which have some degree of capital protection embedded within them, or more broadly speaking, financial products which are either structured products by definition or use financial derivatives in some way. I mean, they're very popular within Europe. There's lots of sophisticated financial products which exist in Europe in that space. So it's not like Europeans are shy of adopting these new ideas and concepts, but we do so in a way which is relevant and suitable for us over time.
So I have a question that on a topic that I know is also close to your heart. You've worked on a lot of topics related to Sharia-compliant investing and Islamic ESG funds, which to me shows a growing demand for value-based investing. What's driving this interest in faith-based ETFs, and how do you design products around that?
Yeah, I mean, there's been an enormous amount of interest in faith-based investing generally, and that's globally, by the way, across Europe, across Middle East, across the Far East, Latin America, where we've been speaking to clients of different kinds about sustainable investing and faith-based investing, generally speaking. So there's real interest in this area, and I think a lot of it comes down to be quite blunt, down to the overlap that we see between faith-based investment concepts and kind of, if you like, traditional sustainable or ESG type in investing. There is an enormous amount of overlap between the two, both in theory and in practice. I mean, the way we classify the investment products that we've created is we put them into the bucket of or within the ethical investment umbrella, and we think that Sharia-compliant investing, so Islamic investing, leans a little bit more towards the S and the G pillar, as does faith-based investing, generally speaking, whereas more sort of traditional ESG investing, if you like, leans a little more in the direction of the E pillar. So what we found in practice, as we've brought products to market and we've toyed with different product concepts, is that there's, they're great complements to each other. They do work very well together. And a good example of that, I think, is in the suite of we brought a bunch of ETFs to market, which are both Sharia compliant and also have ESG screening embedded within them. And we found it very easy to put the two together in such a way that they complement each other very nicely. So generally speaking, there's been a lot of interest in faith-based investing, so investors investing in products which resonate with their beliefs and their principles. There's a big area of intersection between faith-based investing and traditional ESG or responsible investing. And we've done a lot to sort of look at the overlap between the two and try and help investors invest accordingly.
Mm-hmm. And I feel this is part of a wider trend, which is the rise of thematic ETFs also. We've seen a boom of thematic products like AI, semiconductors, obviously clean energy and other ESG related topics. Now you're looking for, I guess, an AI ETF and you get like dozens of options out there. In your view, what makes a thematic ETF actually useful versus just trendy at this point?
Yeah. I think thematic investing is an important concept. I think it's here to stay. If you look at thematic investment products in the passive space, for example, if I think about the growing range of thematic investment products which exist, yes, a lot of them are built around different technology-related concepts. You know, you mentioned AI, there are many others out there, cybersecurity and others. But there are also number of other thematic investment products which exist, which lean a little more in the direction of things like healthcare and longevity and things like that. But when I look at each of the thematic constructs, thematic investment constructs, what strikes me is that they often cut across asset classes, or they span asset classes in unconventional ways. So they may have a smaller, more concentrated number of securities within them, or companies that they're exposed to on the basis of some type of stock selection methodology, which is built around a theme or concept. And as a result of that, they may pick from different corners of the equity market, looking across geographies or looking across sectors, etc. So what you end up with is portfolios which have a very different, if you like, risk return profile to classic benchmarks. And so again, with it coming back to the whole portfolio construction discussion, they bring a different dimension of risk and return to a portfolio. So they give you access, if you like, to risk premium of a different kind within a broader asset allocation context. So I think they're here to stay. They're important investment products. We are seeing a number of tech and other themes come through as being very much drivers of the business models of certain companies which are coming into existence or are changing their business models over time. So it's important to try and capture that and to give investors the ability to benefit from that through investing in companies which are associated with specific themes.
Yeah, I love thematic ETFs. I think it's an elegant way of implementing your views on the world, but of course a lot of times it's a little bit tricky to differentiate like those that really deliver value versus those that are just a little bit trendy. But yeah, I absolutely love like scanning through the universe of different options and the themes out there. Some of them are really creative.
Absolutely. But as I say, super important building blocks. And I mean, one point I should make is that you're absolutely right that thematic ETFs, they can have associated hype cycles with them. So they could come into fashion and go out of fashion very quickly. So you can see assets flow in and when performance is very good, and then assets flow out very quickly. But some themes persist only for a very short period of time before they sort of dissolve and disappear. Whereas other themes are more secular rather than being cyclical in nature, and it's important to be invested in them because they're a slower burn, so to speak. So the performance is you see performance come through over a much longer investment horizon. So it's important to know when you're thinking about thematic investing, how a narrative associated with a specific thematic investment may play out over time, and what that may mean for you as an investor that has exposure to that theme within a broader portfolio. It's important to understand those hype cycles.
100%. Well, it's been absolutely amazing to have you on the show, Sefian. Thank you so much. I think you are the guest that has shared the most insightful comments regarding ETFs. So I hope our listeners really enjoy that. And I wanna ask you one last question before we end the interview. I mean, you've been in the industry since almost 20 years now. So what would your advice be for our listeners that are maybe thinking about starting to work in finance or that are in the earlier part of their careers? What would you tell them so that they have a successful career going forward, maybe as successful as yours?
Sure thing. The first thing which springs to mind is spending time with people. I think it's very, very important to really understand the environment you're in, if you've started working for a financial firm, or if you intend to start working for a financial firm, understanding the different areas which are available. And the only way to get a really good understanding of what a career journey in a specific area of finance looks like is through speaking to people. Understanding how they navigated the twists and turns of their career, what a career in a specific area of finance could lead to potentially over time, etc. Because I think very often people get into banking or get into asset management and they take on the first job which is available to them without necessarily any regard for the medium to longer term, so how they would like their careers to evolve. So I think it's well worth taking the time to do your homework, speak to people, network as much as you can, ask people that have been in the industry for a while for some of their time to really understand how they navigated the industry, and I promise that will pay off.
Well, those are wise words, Sefian. Thank you so much, and I agree 100% with everything you said there. Take your time, network strategically, and most importantly, have fun, because otherwise, nothing makes sense. And especially if you're planning to spend a lot of time in the industry, you gotta enjoy what you're doing. Sefian, thank you so much for joining the Blonde Dollar. It's been absolutely a pleasure. For those of you that want to keep in touch with Sefian and see what he's up to, make sure you follow him on LinkedIn. And Sefian, we wish you all the best. We're looking forward to see the ETF innovations that you come up in 2026 and beyond. And we wish you a very, very successful career within the world of ETFs going forward.
Thank you for having me.
The Blonde Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blonde Dollar for more raw, honest finance conversations.